Joining me on the podcast and on video is Russ Mould, Investment Director at stockbroker AJ Bell. You all right, Russ?
I'm very well. How are you, Justin? You okay? How's in your office? Is it
Yeah.
all kitted up and tooled up
Yeah.
now?
Oh, yes.
Good for
Well,
you.
I'm living in the office because the house is
Oh,
being
that's not.
renovated. So, which is not too bad. But my wife is living in a small room at the front of the house, which is pretty much done. But the rest of the house is still literally, there's builders in there banging and doing all kinds of stuff. So yeah, so I go in the house for a couple of
Finished
hours
by
to.
Christmas?
Yeah, well, hopefully it's going to be
Eh,
finished the next 3-4 weeks.
Oh,
So
fantastic. Oh,
yeah,
great
yeah.
stuff. Brilliant.
And by end of next week, we'll have a kitchen. Which literally at the moment we're in the garage with a
Oh,
worktop,
been there. We
and
did that.
yeah,
We ended
it's
up doing
ridiculous.
ours during the second lockdown, our kitchen,
Oh, really?
which was a
Yeah,
total nightmare.
yeah,
And so that's, I suppose, coming up to 4 years ago. Goodness. But yeah, we were living off one of those little baby belling sort of pan heater things in the
yeah,
microwave, and that was it.
yeah.
So,
Microwave. We got a sort of one of those ninja things, oven
mm,
fryers, and also we got the old double sink sitting outside on 3 bricks. And it's
well,
my job of an evening to wash dishes in the cold with using a hose pipe. And it's like once the new house
perfect.
is done, it'll be wow. We'll be going from I think
Yeah.
we'll really appreciate it because it's living like a campsite pretty much. So
I think I
yeah,
ended up
be great.
washing the dishes in our bath,
Yeah,
which wasn't a
there
great
we are.
experience
Might as
either.
well use it while I'm having a bath. Might as well make myself useful. Yeah. Uh,
Anyway,
there we
there we
are.
go. There we go.
Okay.
Makes a
Let's
change from keeping the coal in the bath, I suppose, anyway.
exactly. Let's talk about well, in fact, the market's well, it's obsessed at the moment. It's the let me just share this screen here. This is the aim, and I'll show you the aim all share, which is literally hitting a 10-month low. And if we go back, there
Mm,
it is at 723. Last time it was this level was the 13th of December 2023. Now, there's all kinds of worries and rumors in the budget, of course, and one of
yeah.
them is about business relief you get on
Yep.
AIM
On
shares.
AIM
If you hold
stocks,
them for
yep.
2 years, apparently, when you pass away, they're immune from inheritance tax. That may be being scrapped. So a lot of people are pre-selling, forward selling maybe. But also another thing that keeps talking about they're talking about cutting the cost of all government departments, raising some taxes here and here. As long as you're not working people, whatever that is, working people. They keep
Define.
stressing working people.
Well,
I think it's
we'll see how they define that next week, because I'm fairly sure that you and I work, but there we go.
yeah, but I was thinking, but also raising they haven't denied it, raising national insurance now on businesses, employers. But I was thinking there are lots of small businesses that employ 5, 10 people, whatever, around the country. And the owner of that are very hardworking, like the shops or hairdressers, whatever. Very hardworking people. How can you say they're not working people? Because I don't understand the definition. They
No, we
box
will.
themselves into a corner. But one of the things is they're going to change the way debt is counted.
Yeah,
It's all about figures and accountancy, really, isn't it? So
it is.
explain how this
I'll,
is going to work if you could, Russ.
I'll
How are they
try.
going to change
I
debt?
will. This all comes back to two rules that Chancellor Reeves has set for herself. One of which is inherited from the previous government, which she said she would keep, but and one of which she set for herself. So the first one is debt as a percentage of GDP should be falling in year 5 of the forecasts.
Yeah.
So obviously there's an element of you're marking your own homework here because it depends on what forecasts you assume for spending, and there's an element of what growth assumptions are provided by the Independent Office for Budget Responsibility. But
Mm-hmm.
clearly, on a 5-year view, there are so many moving parts in that number for it to be, in my opinion, almost worthless.
Mm.
The second number that she's set her for herself is that day-to-day spending should be met by taxation income. So having looked at the spring budget, especially for you again,
Okay.
taxation income was in this current year due to be £1,139 billion or £1.139 trillion.
Yeah.
Spending was due to be 1.226 billion, but that includes 109 billion of debt interest. So you could argue that we
Okay.
weren't a million miles away from being balanced on a day-to-day spending basis. However, clearly there is such a thing as inflation, and that spending number is going to go up in line with inflation, one would assume. And the Institute for Fiscal Studies, independent, non-partisan, has said that just to keep spending on a level footing on an inflation adjusted basis is an extra 25 billion pounds or so.
Mm.
So that's the day-to-day spending calculation. If you want to know where the money comes from, it's basically more than 2/3 of it is income tax, national insurance, and VAT. If you want to know where the money goes, well, a good third of it is welfare and social payments and universal credit. and then £251 billion is health, and the National Health Service, 130 billion is education. Just 70, I say just £70 billion is defence, and we spend 109 on debt interest. Now, as a history student, that's
Wow.
not good. I would genuinely say that's not a great basis for a strong self-defense capability, and we're living in a time of some geopolitical concern. But that's the maths. Now, the debt to GDP number, she's now going to adjust. It sounds like she's going to adjust that. And there are two ways you can adjust a calculation like that. The numerator, debt, the denominator, GDP. And it looks as if she's going to have a little go at both. So on the debt side, it currently includes potential losses the Bank of England will suffer on its gilt program as it sells the asset purchase facility that it did as part of the COVID response, because it bought those gilts when interest rates were at zero. It's selling them when interest rates are a lot higher than that. So it's actually going to generate a book loss.
So
Okay.
to explain it for people, it's inversely related, the yields and the price. The
Correct.
price of the bonds are very high, and the lead yield, and
Yield
now they're
was very
selling them.
low, and now
Basically,
that's
they bought
changed,
high, sold low, which is the opposite of what you should be
which is
doing.
the opposite of what, but they will say they were
Yeah,
forced to do that by
yeah.
circumstance. Now they're selling at a time of their choice, but they want to do it. So there is a loss there that's currently included in the debt calculation. You can strip that out. So you can lower the debt figure to some degree. Then in terms of the denominator, the GDP figure, at the moment, we don't include certain assets in that, such as student loans, infrastructure assets, pension schemes, because they're illiquid. But if you include those, then the GDP number is higher, the debt to GDP number goes down. So if you exclude the Bank of England debt losses and include these assets, you're no longer looking at a public sector net debt calculation, but a public sector net financial liabilities calculation. So we go from PSND to PSNFL if you're interested, where actually the debt to PNSNFL percentage is already lower, and according to current forecasts, it's due to fall faster. So, hey presto, your debt to GDP ratio is lower, it's falling faster. I have more headroom to borrow and spend more. Now, the maths wonks tell me this is creating anything between 20 and 50 billion pounds of extra spending. And Rachel Reeves is saying, I'm not going to spend all 50 because the memories of Trustonomics are lurking in the background, and bond markets are already a bit windy. They want to know that this money is going to be spent carefully, not just spread around. But it does, in theory, create room for spending. And I understand why they're trying to do this. Because if you look at Reinhardt and Rogoff's book, This Time It's Different, which is somewhere behind me on this shelf, when debt to GDP gets above 80%, their math suggests that things get tricky because the interest bill is so high, you're losing out on the ability to spend and invest in your economy. So how you get that debt to GDP ratio down, apart from changing the rules, which is currently our preferred methodology, you can default. We haven't done that since 1672. You don't want to do that. It means you can't borrow, or if you borrow, it's extremely expensive. No, thank you. We can go for austerity. Not much public appetite for that. Not much public political appetite for that. We can inflate. Well, that's a vote loser. The Conservatives have just found that out. We can start a war. No, thank you very much. So your options are change the rules, which is maybe where we're going, and grow, which is the best one. And they're trying to change the rules to create investment for growth. And so I can understand why they're doing it. Growing out of it is what but if we do get investment in infrastructure, then there could be a multiplier effect. So that's why they're trying to do it. So what does the market think of this? That's what our job is to think about. There are two ways in which we're going to measure how this budget goes down. The same way in which we measured every other budget, the same way in which we measured Trustonomics, the same way in which we measured Brexit. The 10-year government gilt yield. How much do markets charge this country to borrow? And then sterling. Are they happy to own assets in sterling after this event? Now, as you can see here, here's your 10-year gilt yield, and the Bank of England cut interest rates on the 16th of August, and the 10-year gilt yield was 3.92%. Now, normally when the Bank of England cuts interest rates, what do gilt yields do? They'll go down. What have they done this time? Don't know. Because of
That's
this,
the thing. I mean,
because of
I'm
this discussion.
highlighting it.
So this is why Rachel Reeves is having to be very careful. She wants to invest to grow, but can't do it on the back of a fag packet. Is a little bit like Liz Truss and Crazy Kwasi Kwarteng did. It's got to be. I think people will be happy to accept investment for growth, so long as it's all visible and transparent and carefully laid out, which I don't think it was back in September 2022. But that is an increase in the gilt yield, so the bond market's getting a bit nervous. I would say that the increase in the gilt yield there is lower than the increase in the 10-year on in the US, where the same issue faces the US government. Debt to GDP is very high and rocketing, and neither presidential candidate has addressed that issue at all. They've both come up with plans that actually increase the deficit more than it's already forecast to do. So the
Yeah.
UK bond yield is rising, but it's risen less than the US equivalent, which so you can argue, you know, yes, it's difficult, but maybe actually Rachel Reeves is doing a better job of addressing it than Kamala Harris or Donald Trump is at the moment, if you wanted to accentuate the positive. But one way in which we can judge how this budget goes down is this chart and where the yield goes from here. And the other one is sterling. Sterling got to 134 against the dollar, has come back to 130 again because this issue is rattling around, but it's actually still going up against the euro to 120 because Europe's got the same issue, and we're currently looking at a French budget that adds up even less well than the British one does. So again,
Yeah.
those will be the two ways in which we'll judge this budget, or A, in absolute terms, but B, relative to the similar challenges that faces our good friends over the water on one side, Europe, and our good friends over the water on the other, America.
Yeah.
That's how you'll
Look,
measure how well this goes down. 10-year yield, sterling.
look at that. I'm highlighting the 4th of July, which was the general election.
Yep.
And it went dropped down nicely after they got elected.
Yeah.
And then a little wobble, and now it's back up just above that. It's above that, but exactly 4th of
It
July.
peaked
So how
under
does
Liz Truss and Quatting at
yeah,
4.43.
yeah.
We're not a
But
million
how
miles away from that, interestingly.
no. Well,
And
how
this
does
is
it
why
work then?
Rachel Reeves will
Go on.
feel that she's boxed in. And this is why, markets are watching to see if she does borrow more, how does she go about it? What does she do to fund it? Sorry, about to ask me something else.
Yeah, I don't know if you know the answer to that. I was thinking this yesterday that Jeremy Hunt says if changing the debt rules, I mean, I saw the replies on Twitter saying you can talk, mate, but he said changing the debt
Yes.
rules will make interest rates go up, and I thought, well, how does that work then? Because if you have the Bank of England now, I think it's 90% chance of them reducing in November,
Hmm.
bringing down the interest rates, then obviously you're selling bonds at a certain rate. So how does that how will interest rates go up if the Bank of England
Well, I
is
suppose
implicitly
there
reducing
are two
rates?
arguments. There are two arguments. The
Hmm.
Bank of England already has to sell 277 billion pounds worth of gilts this year to raise new debt, cover the deficit, roll over existing debt, and cover, and also the Bank of England is selling as well.
Mm.
So in theory, you may have to sell more gilts to cover any extra borrowing, which means we'll always sell them.
Yeah,
It's just a matter of price, right? And as we've just
yeah,
discussed, if bond prices go down, bond yields go up. And normally, when there's an extra more supply of something, what do prices do? They go down, right? So
yeah,
the yield goes
yeah.
up to accommodate. So that's one argument. The other argument is, well, if things get really out of hand in the bond market or the pound really goes through the floor, then you have to put up interest rates to defend the pound. It's the
Mm.
old child's Ponzi thing, and I'm not by any means equating Rachel Reeves with a known fraudster. I'm in any way you're equating
No,
UK economic policy with
as yet
fraudulent
she's not a known
activity.
fraudster.
No, 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 no.
No,
Nobody
as
troll
yet,
me for
no.
this. All I'm saying is that Charles Ponzi once famously said, "Nobody minds you going bust so long as they can't see you going bust." And I
Yeah,
think, and I
perception.
think, and I think here it's Rachel Reeves saying to people, we are in a difficult position, which I think is honest. And I
Mm.
think that's an honest debate that, unfortunately, they're finding their honesty is being penalised. What the markets want to see is how wiggle room is created for growth, and is it done in a manner that is transparent and clear and financed, which I don't think there was a perception that was the case under Liz Truss and
Yeah,
Kwarteng.
yeah, yeah,
Yeah.
yeah, yeah, yeah,
So
yeah.
this is
I
what
suppose
Liz Truss
they
is
have
trying
to.
to
Yeah,
do. Is saying, look,
no.
we've got to
Mm.
try and find some way of generating the growth that will help us get debt to GDP down, because over time that will reduce the interest bill and give us room for maneuver. And I think that's what she's trying to achieve. This change of rules won't affect the interest bill to start with. It might do if inflation stays low, because a lot of our debt is index linked, and so that would help. So what she's trying to do is not is a give herself room to do it, but then sustainably do it so the interest bill comes down, and that's what she's trying to achieve. And frankly, I hope she succeeds, because we all need that really, 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 very, very, very much, because spending 100 odd billion pounds on debt interest is not great. And so you don't want to see this bond yield go up, because that
Mm.
increases the interest bill. It doesn't decrease it.
Yeah, yeah. Funny thing is that I mean, she's saying you want to cover day-to-day spending via tax take. I understand
Correct.
that completely. And then they're changing the
The
debt
interest on
rules to
top.
get, yeah,
Yeah.
and trying to get the debt rules changed or changing them to become, investors in the economy. But there's, like I said, and that's why they're cutting or raising taxes or cutting department budgets to
Correct.
cover those day-to-day spending
Correct.
limits. But so they don't want investment and growth as well. What I find a bit annoying, as I obviously I'm an investor, is that now the definition of working people, Keir Starmer said today that it didn't include people who own shares or property or income from that. I thought, well, hang on a sec. You are investing as a government. You can't discourage people from investing. And if you look at, in America, there's a different attitude towards investing over there than there is here. And, America's got the deepest capital markets, some amazing businesses out there. And that's come from entrepreneurship and encouraging people to invest. I just think they're going about it the wrong way a little bit. I do think you should encourage people to take ownership in businesses or property, try and create your own wealth. Because I think what's happening, it's laudable they're going for these big infrastructure investments, but they take years to bear fruit. And I think if you're clamping down or raising capital gains tax, all this, or removing business relief, that's kind of a short-term knock on the economy, I believe. And even in fact, raising national insurance on employers, that's kind of a short-term knock. So until these big infrastructure projects pay off, I think we're going to have a problem with the economy. I really do. I mean, employment figures this week, are looking good. And the PMI is not looking very good. Labour market's weakening. I think they're going to be in a very sticky situation until these big sort of infrastructure
Yeah.
projects pay off, if they do.
I think again they would say that they've inherited a sticky situation, which
Yeah,
I don't think I think is a perfectly fair comment. And they may also be taking the view, look, we're in for 5 years. We've got a thumping great majority here.
yeah.
We have got time. And
They
although
can afford to take long-term
they
decisions.
can,
Yeah,
and frankly, long-term decisions are what's needed because that's what's
yeah,
going
they
to get us
are.
out of the
Yeah,
mess. So
yeah,
again, that's the counter argument. The other argument about working versus non-working, this is the Keynesian extinguishing and taxing the rentier thing. Is it fair that we have loads of landlords who just buy a property and then milk that? I don't want to get into the politics of that, but that from a left-wing socialist point of view, that's very much the Keynesian extinguishment of the rentier argument, and it's out there, and we know it's part of. You could argue it's part of well-established left-wing thinking. The danger, the counter-argument, is the old Churchill thing. And by his own admission, by the way, he was a terrible Chancellor of the Exchequer. But he argued famously that trying to tax yourself to prosperity is like trying to stand in a bucket and lift yourself up by the handle. It's not going to
yeah,
really work.
yeah.
And I think the danger is, yes, you disincentivize entrepreneurs to take risks,
Mm.
and government, whatever you think of it, does not create wealth. It provides the platform for wealth creation by educating us, keeping us healthy, defending intellectual property, keeping us safe, and funding all of those vital services. But the actual wealth that the government spends is tax money. The government doesn't generate that. That's created by business, by entrepreneurs, by individuals. And so you've got to try and get the two to work together without wishing to sound like a sort of Tony Blairite third way um, advocate. You've got to try and get the two to work together. It's not one or t'other. But yes, if you say to people, we will let you take a big risk, and if it pays off, we'll clobber you with tax, and if it doesn't, well, you can suck it up. That is potentially a disincentive to people to take risks, and there is no doubt about it. In America, the
Mm.
attitude is currently different. Although,
Yeah,
again, I've got American friends who talk about Kamala's Whaler rather facetiously, if that's that's their view of her, and that more taxes may be coming down the pipe there. So, but again, the issue is how do you deal with the debt? But I think
yeah,
encouraging growth is great, but if you then give a whiff that you're going to penalize success, the danger is there is less risk taking. So you've
yeah.
got to try and get the balance right, and let's hope that they succeed. But it isn't going to be easy because the starting point is very, very tricky.
Yeah, and I think it's no apart from the size of the economy in America is bigger than ours, of course. But they have got companies there that are globally relevant, many of them, and you're thinking there's no
Yeah, they have
accident this happens. They
no, they have
keep
a bigger
doing it,
domestic market. They have a bigger domestic
Yeah,
market. They venerate success. They aren't
yeah.
repelled
The
by
culture, our
success.
culture's wrong, isn't it? It's
The
almost like
cult, the culture
we're
is that
tax success here,
if there's failure, it's so what? You just pick yourself up and get going again. Nobody takes the mick on and uses it to brand you forever, which I think they do here. Um, and so those things are all in your favor. You have the deeper pools of capital, which I think is there. So there are cultural things that are going to be very, very different there for a long time from what they are here.
Yeah, yeah. Do
And
you
the
know what?
size of the
It's
domestic
like
market is a big thing as well.
yeah, exactly. But you know what? I was looking at stats a while. I think it's something like over 60% of Americans own stocks. In
Yeah,
the UK, it's around about 30%. So
yeah.
That's the difference. It's more, and I believe you should encourage people to invest in businesses, get to know businesses, and a lot more ownership in this country. You know, creating your own wealth rather
Well,
than,
then you have
like you
then you have
say,
a greater stake, right? And then you have a greater
yeah,
incentive. And I think that's the different philosophy
yeah.
between the parties, you could argue at the moment. But one thing
Quickly,
that is,
oh,
yeah,
go on.
paying attention to this, gold and silver are paying attention to this debate on both
Yeah, I was
sides
going
of
to
the
say,
Atlantic.
look at
And
gold. I
that's
mean, it's
why.
always, if you own a gold mine or you own gold, you're doing well, but you've got to question the reason why it's doing well, because
Yeah.
sometimes that isn't as reassuring, you know?
No, I think it's because on both sides of the Atlantic, investors are looking at, well, how is this debt going to go down? Is it going to be sleight of hand, or is it going to be taxes? Is it going to be lower growth? And well, that's okay, fine. But are they, heaven forbid, going to go back to, if bond yields start rebelling, right?
Mm.
Do they go back to quantitative easing to start trying to artificially suppress the bond price, which means more money printing, which means, again, the supply of money goes up, the value of it goes down relative to other things. And I think that's why gold and silver have been doing well. It may be why Bitcoin has been doing well, though I get the impression that people view it kind of equating Trump and Bitcoin as the same thing because he's seen as pro
Yeah,
crypto, anti regulation. Who knows? But I mean, it may all be part of the same package, but certainly haven assets are currently motoring. And I think it may be in response to this bond yield thing, public debt thing, just looking at, okay, you've got new parties, you've got a new government here, you can have a new president in the US, whoever wins, they're going to be faced by the same issue that Reeves and Starmer are facing in the US. What are they going to do about it? And if the answer is actually do nothing or spend more and make it worse, then again, longer down the road, there may have to be a policy response, which is either we take a chance with inflation and cut rates to stimulate the economy, or we go back to QE to print money to meet the interest bill. That's what gold bugs and silver bugs are thinking. Whether they're right or whether they're wrong, we'll find out. But that's what they're getting windy about, and that's why those things are going up right now, I suspect.
wow. Fancy going back to QE.
Fancy going back to QE, eh?
It seems like just
I would view
they
that as a
haven't never
doomsday
stopped it
scenario.
really. I know.
Well, they are. They're trying to. I mean, at the moment, the Fed's balance sheet is shrinking. The Bank of England's balance sheet is shrinking.
Yeah.
The ECB. So they're trying to get rid of it. They're trying to do the right
Mm.
thing and wean us off it. But hardcore gold bugs will say, well, they're going to go back because of this debt situation, and that's one of the rationales for gold bugs, as it were. One of their some of one of their core planks for why gold could keep on going from here, if you believe that.
Yeah.
Now, on
I
talk
think
about
it's
sitting on top of a gold mine, Newmont Mining last night had a big profit warning because it's bought
really.
Newcrest and it's encountered all sorts of operational and integration issues. So actually, sitting on top of a gold mine isn't always what it's cracked to be. The shares got murdered last night, which was
Are they?
quite they did, yeah,
Wow.
which was quite intriguing. It was down about 14% last night. So just keep an eye on that as well, because there's been lots of gold M&A. So gold miners have been positioning themselves for this
Oh, look
spike
at
in their
that.
gold price. But Newmont shares got crushed last night.
Yeah. Down 15%
There
in
you are.
one
Look at
session.
that. They made an absolute mess of it.
Yeah. There we are. Marvelous stuff. Russ, thanks for that.
Good to
And
catch up.
well, yeah, we'll
See you
speak to you in
soon.
four
I'll
weekies.
look forward
Yeah.
to it.